Okay, so our presentation goes into sort of three logical parts. The first part Rod will deliver, which is who we are, what we do, how we do it, and who we do it for. So the Proactis business in summary. Then there's a short update on the key aspects of the preliminary announcement that we put out last week, so the results for the year to July 15, and then a little bit of a track record for the years that we got to that date. And then finally, and most of the presentation should really be around the growth story. So there's some figures in the market through FinCap's note, which cover part of the story, but obviously we want to get the wider story out to you. So we'll spend hopefully most of the presentation talking about that. So Rob, to start with on who we are, what we do, and who we do it for.
Yeah, good evening. An unusual venue for me. I'm not sure whether Tim's ever done one quite like it. As he said, just fire questions at us if you have them. My wife said last week, you two look like Eric and Ernie. I hope we're even approaching their sort of capabilities and style. So Proactis, 2002 really was the start of it, and we are what we call spend control and e-procurement. That has many different names and many different titles. It could be buying, it could be purchasing, it could be E this and I that. But it is the procurement by a fairly large organisation through a number of suppliers and everything that they do around that. We are the UK's leading independent solution provider. Our software helps our customers improve efficiencies and the effectiveness of procurement. So you've got two halves of the thing here. It's not only what we're buying, what we're sourcing, but how efficiently we're actually doing it. So if you go back in history, I was privileged enough, or old enough I suppose, to be working in about 1980 with things called EDI and Tradernet and Code 39 or Code 3 of 9 and Tesco's and Cadbury's and all of that sort of thing. Well, this is just the same sort of thing that we're doing, but we're doing it in 2014, 2015. Unfortunately, a lot of people didn't catch up to what Tesco's and Cadbury's were doing. So there's a lot of organisations that are caught in no man's land doing lots of things in a very uncomfortable way with paper and things like that. Business to consumer, on the other hand, is very, very slick. You know, your kids are spending money on your credit card all the time. You know, I know that my son looks on the web and drags it in and buys it, and it's very easy. And if you were starting commerce today, you wouldn't be doing a lot of things that we're automating. So we're looking at reducing costs, we're looking at increasing control, we're looking at things like risk and compliance. So it's not just how much you're buying, it's also what you're buying. And we want to take that risk away. Who do we do it for? I describe them as biggish companies. We all describe things as blue chip. Are they blue chip? Well, they are in terms of size compared to us, but you would know most of the names. Now, whether it's the likes of Lloyd's of London, Europcar, Virgin, whether it's a lot of the big councils and things like that, and some of the big charities and what have you, you would know the names. And in the back, you'll see a list of them, and you'll see a list that we deal with over in the United States as well. And across the bottom of the slides, you'll see the ones we closed this year. And Tim will keep referring to it, and I'll keep referring to it. We do roughly 40 new deals a year. So we're reasonably competent at selling to fairly large organisations. All of our money comes from selling to those 500 blue chips. They in turn deal with over 1 million suppliers. And the trade that goes on between them is something over 50 billion. So that's the sort of scale that we're dealing with. And we're in 90 countries, we've got millions of users, and we set the thing up on day one to become multi. Now, that means multi-currency, it means multi-language, and it means multi-organisations. So companies can buy it with one procurement system sitting above many different financial and legal books that might even be in different currencies in different countries. So we built for the most complex model. So architecturally, our software is very strong. We offer SaaS and perpetual. When we started, there was no such thing as SaaS. SaaS has come along fairly recently. We used to sell a perpetual license We sold maintenance and support for ongoing years. And we have a number of our clients that still do that with us. We sell through resellers as well as ourselves. So we have business partners that sell our software. The software is commercial, off the shelf. We don't do modifications for anybody. That means it's very hard. It's very, if you like, rugged, Tonka toy. So that other people can sell it. So they can sell it in other parts of the world and they can sell it in the UK as well. And it's horizontal in nature. We are not limited by the number or type of organisation we can deal with. It's an almost unlimited set of organisations. We are stronger, clearly, in the service industry, where a service industry has two costs: stuff that it buys and payroll. That's all they have. If it's stuff that they buy, obviously we're very strong in that. And the scale of our business is approaching 20 million, and we've got roughly 69% of that growth. That's on a CAGR basis. Some of that has come from M&A work. We sell, as I said, 40 new names, and we do roughly 80 upsells. An upsell for us is somebody paying us for something they didn't have. Extra facilities, extra seats, and so on, extra countries even. And we have about a 95% retention rate. We're very well covered when we go forward. We're probably about 80% of our revenue next year is already done and contracted. We have an expected revenue that comes as well. So it's not just how much is contracted. We have some that we always get. As Tim says, you don't have to sell it, it falls in the door.
Well, it's not quite like that.
If you're in finance, I'm sure it falls in the door. If you're in sales, you kind of have to sell it. But we do have this ability with our license. As you go through a sales negotiation, people try to take the price down. If they take the price down, we take stuff out of the shopping cart. So we skinny down what they get for their money if they're driving the price too hard. We can then go along later and upsell that shortfall. So our license file will allow us to do it on a module basis, a seat basis. It'll allow us to do it on throughput, so a count on the number of transactions or a count on the value. So we can license it which way we like, depending on how the client buys it. If someone knocks on the door and comes to us direct now, there's a 95% chance that they will buy a SaaS license from us. SaaS for us is 5-year committed on a contract. So it's a very good transaction for us. It gives us great visibility going forward. It may give us revenue recognition issues in year one when we were doing the transition, but we started this transition maybe 4.5 years ago now. So we're out of that transition and now we've got our order book building. We're profitable. We made 4.8 EBITDA and we pay a dividend. So if that's a key feature for some people, then we pay a dividend. I think it's probably worth mentioning that maybe 3 years ago we sat there and we tried to decide the disconnect that we were all feeling. The disconnect being we were saving a lot of money for our clients, but we weren't actually creating value for the shareholders. We weren't a valuable company. So we tried to have a look at what would make us a more valuable company. And we decided it was about 5 things. First one was absolute scale. We were too small. We could get a re-rating if we were quite a bit bigger. The rate that we were growing, we grew last year 12%. I genuinely don't think I can grow it much quicker, organically. 10 to 15% is the spread. 10 to 12 typically would be what we could do organically. Well, we believe to get a decent valuation, we had to grow at probably better than 35 points. So, bigger, growing faster. Better visibility. At the time, we had 2 million visibility of our forward order book. Now we've got something like 19 million visibility. So we needed to be bigger, growing faster, better visibility, making a profit, and lastly, paying a dividend. So we set out to do that maybe 3.5 years ago. And we think, you know, when Tim gives you the results, you'll start to see the progress we've made against that. Market growth. People often say to me, who's your competitor? I don't know. There's too many of them. They are in different sectors, in different countries, in different regions, using maybe different financial systems. So we know them all. It's a matter of qualifying which ones we're going to compete with on any given day. But the market as a whole is growing. On the right-hand side of that bar chart there, the histograms you can see with the stuff. So the market is growing at a nice level. On the right-hand side, you'll see different acronyms: supplier network, service procurement, EIPP, which is electronic invoice presentation and payment. We play in all of those, so we can get 5 or 6 different decisions when we go to market to compete on the open market, and then we can develop the account from there. So on a whole, that market is growing. It's predicting to carry on growing. So how big is big? Well, pretty well every business in the world buys. We're present in every country in the world if we want to be. So we're not tied to a market sector or anything else. So it's an enormous market sector. Our percentage of it is so small that we don't really need to worry about it. It's minuscule, so lots of opportunities for us to do that. And I suppose having a horizontal marketplace like that means that we only have one code base. That code base is very firm and very rigid. It's our marketing material when we go to market that has to change to make us good for, say, oil and gas. Fortunately, one of our resellers is big in oil and gas. They've had a terrible time in the last 12 to 18 months, but we're not just in oil and gas, so we're able to make it up by going into other sectors. So that's really it. Our value proposition is on saving people money, making them compliant, improve return on capital, supplier security and things of that nature, making the business more agile, reducing risks, and automating is the key. And Tim will talk about some of the things that we're doing to automate it. You won't get a lot of the benefits you're looking at unless you can automate. And it's automation companies like ourselves that will actually bring that level of benefit to it.
Excuse me.
Yeah.
Sorry to interrupt. There's a quick question then. You say you haven't got any competitors. When you pick
No, I didn't say we haven't got any. I said I've got too many to mention.
You've got too many to mention,
yeah.
When you do pick up new customers, are you typically replacing a third-party system they already have, or maybe an in-house system, or could you just describe what's typical?
We're always replacing something. Quite often it's in-house. Quite often it's an older version or a partial version. A company called Ariba really were one of the founders of this industry, got bought by SAP maybe 2 years ago. We've replaced that 3 or 4 times because I think the market believes that SAP will kill Ariba in the form that people have come to know it. And it's not having the development dollars spent on it to keep it fresh, easy to use and all those sorts of things. And the other thing, we're a lot cheaper. And we should never walk away from the fact that we are sometimes more cost efficient than some of the competitors. So we're always replacing something. But on that list of things down the right-hand side, there's contract management, for example. We've got clients that would be using SAP and they would want our contract management solution. So it's not boom or bust, if you will. You know, we can sometimes sneak in the side door to actually get some of our stuff in there.
Yeah, each one of those sides on the each one of those descriptions on the right-hand side is an entry point into the customer. So you don't need to sell the whole thing, and actually we don't like to sell the whole thing in the first go because we like the upsells afterwards. So any one of those could be a particular pain point for a customer, whether they've got something that's not working at all or they haven't got anything in place, you know, in an existing way. So any one of those points is an entry point for us.
Yeah.
Can you explain the point about business agility and how that, you know, you've also mentioned that your code is very fixed, so I don't quite understand how those two work together.
The code is fixed for a couple of reasons. One is it's more efficient for me to write, it's more efficient for me to test, it's more efficient for me to educate people in terms of how to use it. It's not that the code is stagnant and sort of stationary, it's not. We're always updating everything. It's really a matter of saying, if you build the code properly, you can then roll it to a number of places. So building the agility into it is giving you lots and lots of options and switches, so that you're probably only using 10-15% of the actual application. Somebody else might be using another 10 to 15%. We have to make sure that people are able to do the things that they want. Half of our job for a client is future-proofing what they've bought. You know, somebody comes along and says, "Oh, I want to run it on Android." Well, it's no good me saying I can't run it on an Android. I've got to be in front of that. So we've got to always be looking at what's happening in the market sector and how it will drive us. We do a lot of that with our clients, but we also do a lot of it for ourselves. You know, sometimes we're ahead. Yeah.
Who in the organisation are you selling to?
My first phone call, if I could always make it, would be the Chief Financial Officer, FD, whatever you like. Most of the benefits accrue that way. Quite often it's to the procurement function. It's virtually never to the IT function. The IT function with a SaaS involvement as well tends to be very marginalised these days. So, yeah.
Just thinking about M&A.
Yep.
Are there any other reasons for doing M&A apart from increasing your top line growth? Are there any operational reasons for the volume of M&A that you do?
Yeah. We can come on to some of those later, but access to certain market sectors that we've not got to would be a typical.
Yeah, all three of the acquisitions were done for different reasons.
So we'll talk about the three acquisitions
describe
we've done in the last sort of 18 months and how we've sort of taken them forward, and Tim will give you a lovely technical term for what we've done with them. We haven't cocked them up.
And is your retention number an aggregate retention number? So
Yeah. Yeah, across all the group, yeah.
One of the things we're looking for when we're looking at a company is sticky revenue. And obviously if we're looking for M&A work, we want equally sticky revenue.
So you mentioned with SAP buying Ariba 2 years ago, and you said something about they're slowly not investing in Ariba and they're just letting them fizzle out. Is that right?
I don't know that that's true, but there is a customer view of that.
Okay.
The software's a bit clunky anyway, and there seems to be this belief that it's expensive. Expensive, clunky, fear of SAP not investing.
So SAP's target clients tend to be the big ticket logos, a little bit like yourselves.
Yeah.
So what's stopping SAP taking over a 20 million revenue business
Nothing.
like yours,
Absolutely
and then
nothing.
just doing the same with Ariba?
Absolutely nothing.
Nothing at all.
No.
And
if they knew we existed, they might.
Yeah, and in fact, at our level, we would feel more fragile and exposed at this level than something much larger. Certainly, if you look historically at M&A on software companies, very few get above 5 million before being acquired for a technology player generally. Very rare you get over 10. When you get to 20 million as an independent, then you're pretty vulnerable to take over. And of course, if somebody pops in with an offer of 50% above a listing price or above the share price, the directors have to take that into consideration. Now, we have no intention at all of selling, and we've got some really aggressive plans, and hopefully you'll understand what we're trying to do, at least after the end of the presentation, to get through that range of vulnerability as quickly as possible to get to something really substantial. And just to describe the acquisition price of Ariba, which was about an 80 million revenue business doing about 15 million of profit, 15 to 20 million of profit, I think. They paid 400 million for that company. So as a strategic acquisition of something really significant with a lot of recurring income, that's the kind of model we're looking to emulate.
There are some technical reasons why they wouldn't. We are not on SAP technology. We're a Microsoft house. All of our software from top to bottom is Microsoft. So it's not that SAP wouldn't buy a Microsoft house, but they would be less likely to.
Can you just elaborate on the sort of the range of organic growth? You sort of said
10 to 15 is about the stretch.
And why is 15 a cap?
It isn't a cap. It's just what we're generally able to deal with our. I mean, it's ultimately each year we invest in three things for the next year's sales and the next year's and the next year's sales. One is development of product, and we spend £2 million a year on that. One is marketing, and one is sales for those. And it's quite a high cost of sale. The sale process is long and difficult, can be 6 months easily to get to a contract. But what you're investing in that expense is the next 10, 15, 20 years of customer life and customer revenue. So we have decided to invest at this level, and that level gives you a certain capacity, and the capacity that we think it gives us is 30 to 40 new names, doing 60 to 80 upsells. That's the risk profile that we've taken on the investment. It is possible for another group of managers to take a much higher level of investment each year. If you looked at Cooper, for example, they invest many, many millions more in marketing and sales team to make a land grab for names, but they make a loss. And our fourth measure of a good value company is profit. So we want to make a profit. So we limit that investment to win the certain number of new names. You have to scale up quite a lot of the organisation behind that initial investment in sales marketing. We think that's it's a risk level that we're comfortable with where we are today.
I think, just to add to that, I completely agree with all of that. It is, can we get competent people quickly performing and selling across whatever market sectors? And historically the answer to that's been no. We've had the same sort of success as everyone else, and it's about 6 to 9 months before you can get a salesperson competent to sell it, even if they understand the procurement market. And that's a level of investment that we have had a little play at that in 2006, 2007, and it really hasn't worked out. So as Tim says, we fix our pipe size, we fix the size of the organisation based upon what we can sensibly handle without taking on too much risk. I mean, could we take more risk? Yes, we could. We prefer not to.
There's one angle, we'll show you the growth plan shortly. There's one angle where, so that doesn't obviously give you a J-curve on sales and everybody can fly off into the sunset. What does give that opportunity though is an automated attempt to access the suppliers of our buyers. So hold the thought, because that's a large population that you can do through automation, which is different from the hard selling to the buying organisations that we're doing now. So hold on to the thought.
So just quickly finish off before I pass over to Tim. What we try to provide is a cost-effective solution that's very, very fast to implement. Typically we implement it in 12 to 24 weeks. You'll get a payback. I know it's a bit difficult with SaaS to actually work out what the true payback is, but you should get a financial reward and a payback on that. It should cover its cost within 6 months, or you're doing something really silly. So it's a very compelling argument. It's a very scalable solution. You know, we've got people that are doing 2.5 to 3 million invoices a year through it. We've got people that are doing small stuff. We've got, I suppose the biggest population is 12,500 coppers using it as a portal to buy some stuff that a few people have said. So it's very scalable, it's very robust, it's Tonka toy, it's modular. Strong user interface. I don't think it's a bleeding edge user interface, but not many people struggle to use it. We have the mobile devices as well. You can have a combination of licenses, or you can pick SaaS, or you can pick perpetual. Quite often we get a mixture now. We are technically agnostic, so it means that whatever device you want to put in it, whether it's an Apple, an Android, a Dell or whatever, you can actually access the software remotely, and it's pretty future-proof. You know, it's as reasonable as you can sensibly predict. So that's really what we're talking about. But just to set it up for Tim, we have 500 clients that pay us all of our revenue. They deal with something over 1 million suppliers, SME suppliers typically. And the transaction value going through our hub, our engine, if you want to call it that, is over over 50 billion. So I did a test on that because I didn't believe the number. I did a test on that and I found 3 clients within the first 10 hits doing over 2 billion a year with us. So it's got a lot of transactional value going through it.
One question. You talked about 95% retention rate.
Yep.
Can you give us a couple of words on the 5%?
Yep.
Why and where?
Afron Oil Company last year went out of business. I think that was fairly well sort of noted. We have one going through at the moment, which is a company called A4E, Action for Employment it used to be called, based out of Sheffield. I can't remember who they're merging with, but they're coming out for, they're coming together, so I'm losing one of the two. They were both clients, but I'm getting a sort of a shell off and things like that. So it will be that sort of thing happening. Mergers and acquisitions is the worst, usually.
Sometimes you get a sharp guy looking to save a bit of money and they want to reduce their support bill from 100 grand to 90 grand, something like that. So that people do try that. If they're paying £100,000 a year, where are you going to go with that? I mean, are you going to cancel? If not, yes. So you're going to try and get them to stick around. So what we might do in those sorts of instances is, rather than sign them up for 1 year at 90, we might say, you can have that if you extend for a 5-year contract or a 3. So we're always trying to get the commitment and the term as long as possible. So if we give...
Or give them some more software.
Or give them a bit more software to get it back to 10.
Yep.
Because software is a zero cost on that individual item. So anything to try and get the commitment.
Just on that software point, you mentioned being a Microsoft-based technology. Microsoft tend to provide upgrades and updates more regular than they ever have done before. Does that have any effect on your technologies, or have you wrapped your own IP around it? Do your clients have to update when Microsoft update, basically?
No, it's not quite as bad as that. Microsoft will always support older versions of stuff for a period of time. But yes, it has an effect, and we have to make sure that we adopt it. Because our relationship with Microsoft is we see the technology a lot earlier than you necessarily see it down the high street. I can't say we're always out the door with it first, but we've got a head start, and particularly on the SaaS stuff, we will make sure that everyone is on, if you like, the latest technologies and things of that nature.
Has that ever been a disruptor for any of your clients in the past?
No.
We don't have an arrangement whereby we have to back our license with some Microsoft licenses. There's no in-licensing cost from us. We're just a partner of Microsoft, and we use their technology to write our software.
So our IP wraps all around it and through it, but obviously we use Microsoft .NET toolset. Off the top of my head, I think it's .NET 6, but...
Do you develop this in-house?
Yes, we develop it in-house, most of it in Wetherby.
Of course.
That technology hamlet somewhere just wide of Leeds. Yeah.
It's fairly obvious how your purchaser contracts work. How do the contracts with suppliers work, and is there any exclusivity in that?
This is absolutely crucial.
This is crucial. At this precise moment in time, we don't have any.
We're not a procurement company. We don't buy and sell things for...
Those 1 million suppliers do use our network. Their data is backed up using our skills and our expertise, and they take data storage and all those other things, but we're currently not charging suppliers. And that's the basis of one of Tim's slides.
So it's free to suppliers?
No, it has been free to suppliers.
Having potted along in sort of 5, 6, 7, 8 million turnover till 2011, 2012, what's changed?
Yeah, loads.
Why the vision? Why?
Yeah, absolutely loads. We floated in 2006, obviously, and at that time we were certainly sub 5 million of revenue, selling tens of deals, small tens, teens of deals per annum. And we got to the position in 2010 where we were about 8 million of revenue, 1 million of operating profit, and 2 million of forward visibility of contracted income, so equivalent to that 14.3 million we're at today. And so that's an inherently fragile business, which was susceptible, because we were perpetual licenses only, really susceptible to large swings on profit that makes equity investors incredibly nervous, obviously, and bank debt impossible. So no access to any kind of finance, really. So as Rod described earlier, we had a real sort of soul-searching job here and said, well, look, we know that our clients are fantastic. They stick with us. We win 30 to 40, we win a high number of new names per year. We're selling, they're buying again from us throughout their lifetime with us, and they're sticking with us for a long time. That disconnect doesn't match with a valuable company. How do we make it valuable? And that's where we got to these 5 measures of this is what makes a valuable company, in our opinion. Number 1, growth rate. And that rate organically has not really changed. The momentum hasn't changed. 30 to 40 new names, 60 to 80 upsells per year. That's the same momentum. each year. We've got this fixed investment where we do it. So growth rate. How do we get to high growth, valuable companies? Well, you must, Rod says, I can do 10 to 15 organically at this investment rate, and I'm comfortable with this investment rate. So what do we do? Well, you have to do M&A. And it's got to be selective and the right one. And there can be very different reasons for each one of them. So we needed to get to that level. Now, how do we get to M&A? Well, M&A, I need to be able to access debt markets, and I need to be able to access the equity markets to be able to fund it, because I can't do it through cash flow at this level. It'd take me 10 years to buy a company. So that involved shifting the business model to something that allowed us to be more predictable and investable. So in 2010, we changed the business model to offering a subscription-based business model, which would be 3, 4, 5 year generally contracts forward. That gives you the fixed income, it gives you the certainty. And that took us 3 to 3.5 years to come out of that. So we started that in August 2010, came out in July 13 results, and you'll have seen in the pattern going like this slightly and then wham in 2011. So that's the first time in that year. I think we sold 30 deals. 15 of them were perpetual, 15 were the subscription. The revenue from the subscription income, which is 5 years forward spread, comes out of that year's earnings and it hits the profit immediately, so straight through, wham. But the next year you get the step up from the deals that you won last year, and the next year you get the same. So you step back up. So in 2013 we got back to sort of parity in the business. 8 million of revenue, about 8 million of revenue, 1 million of operating profit, 1 million of operating profit-ish. But importantly, visibility, 7 million of order book. So really fantastic visibility there for institutional investors and banks to get behind. So then we look at our shareholders, and we've got to say to ourselves, are these shareholders that can support this strategy of M&A on top of organic to deliver high growth, which is valuable? And the answer was no. So we needed to change that, and so we went out on the road with that story of take us objectively, don't look at the 7 years, look at the last 3 years and see what we're trying to achieve. And Henderson believed the story. And they got us at 36 pence, which was a 20% premium to the share price on the day. So for 25% of the stock in an illiquid AIM company. So they really have to believe the story to do that. And they did it, and then we were off to the races. So we've really only been Proactis today for 2 years, 2 years in November, with an M&A strategy on high growth with high degrees of visible income. We've really only been doing it as is for a couple of years. Yeah, sorry.
On the SaaS part, the revenue model, do you engage in any discounting? And if so, can you give us some colour on that? And also, how do you comfort it? Is that on the revenue line, or do you put that into...
There's always a fight on price. If that's what we mean by discount, we always fight on price, and we get to a level that we're comfortable with.
The lifetime value of the contract, or how do you do it?
Well, if you sign a contract over 5 years, then you would take a 60th of it per month. Yeah. So that's how it's accounted for. Much like
what we don't do is, if this is what you mean, discount the revenue in year 5 as a smaller number and discount it back and create a sort of an artificial finance.
It's taken evenly right the way through the...
Just take it evenly over the 5 years of the contract.
Yeah, or engage in any colourful discounting where you're
not...
No.
None.
Straightforward figures, straight off the contract.
I think there's a slightly quicker version of getting it. The boys convinced me that we should do M&A. I wasn't always as keen, but we've been very selective in what we've done. I think the SaaS model set it up for us, and having taken the pain of going through a migration from licensed revenue to SaaS on a public market, I mean, that was really the catalyst that sort of...
To give you a feel through that transition, nothing actually in the business changed. We still sold software, we still sold 30 to 40 new deals a year and 60 to 80 upgrades per year. Nothing changed in the momentum of the business. It's pure accounting rev rec that was the issue.
And we paid a dividend right the way through.
And we paid a dividend throughout to demonstrate the confidence that we had in, at some point, somewhere between 2 and 5 years, you would come out to parity. And with us, it was 3 and a little bit. We came out to parity. And it was only after we announced and showed in the income statement of year 3 that we were at parity that the market believed us. And of course, that's the way it should be, because you've got to believe what you can see, not what we tell.
So we move on to the good bit.
Well, it's a different bit anyway.
I mean, all of that stuff's good, but I mean, there is a set of plans, I think, which are potentially.
So a quick first of all, just on what we've done in the year, just for the results, just to highlight some attention. So overall growth in the business, 69%. Clearly, we've had the first full year of effect of 3 acquisitions in the year. The third one was done on the 1st of August, which is the first day of our financial year. So full year for 3 new companies in the group. In the previous year, we had 2 companies for stub periods. So to compare like with like, what we've tried to do is pull out what the organic growth is as well, so you can see the impact of both. And the weighted average organic growth of each one of those 4 businesses is 12%. So that's healthy. 10 to 15% is Rod's range of organic growth. So we're right in that range. That's a good, sensible amount of organic growth. But we're adding to it with M&A, and that's the difference to get to 69%. So we're achieving high growth. We're doing our organic growth. We're increasing rates of profitability. So we've described the EBITDA margin, but it would be the same on the EBIT margin, and it would be the same on the bottom line statutory operating profit margin. All of those margins have increased as we've taken some costs out of the acquired businesses where it's relevant and not where it's not, but some element of that, and I'll show you the number later. But we're also starting to see leverage on the fixed costs within the business. So even if it's just the PLC costs, we only need 1 chief executive, we only need 1 CFO, we only need 1 chief operating officer. Those fixed costs in the business are starting to get leverage. There's very few variable costs in this business. The main variable cost is a little bit around the support function, because you need more support people to deliver more customers. But the reality is that the only significant variable cost is the cost that we pay our resellers for selling. So we give a margin away for that. So mainly fixed costs, but we're starting to see the leverage of that and getting more profitable. We're just short of 30% EBITDA margin, and that number's reasonably substantial now, 4.8 million. Key number as well is the EBIT number or PBT number, and that's 3 million underlying before all of that stuff around customer-related intangibles and those non-recurring items. So increased rates of profitability. Next point is around the visibility. So real substantial growth in that, 14.3 million of contracted forward income against a target in the market of 18.9 through FinCap. And again, with that layer on top of visible stuff, we can't see it today, it's not contracted, but it's probably going to come in to take us to about 16. And if you look historically, that upsell number is 60 to 80 each year with some consultancy on top. It's about £1.5 million to £2 million. So real great visibility. A slightly less useful number, but still one worth just reporting, is the forward order book in its entirety is £20 million. So forward order book here is a bit different to an annual figure for next year. It's the rated order intake over multiple years. So if we sign a subscription deal on the last year, it'll have some income in 5 years' time to come through. So less useful, but still a good number of contracted income. And of course, we're sort of around about scale now, or touching the bottom of scale at 20 million, certainly well ahead of where we were sub 10 million only 18 months ago. So that's the financial side. On the operational side, order intake, we've done about 40 deals each year, last year, this year. 5.2 million or 5.3 million last year of total order value taken in, 5.2 million this year. An important thing that we drew attention last year, if you look back in the notes over time, you'll see that we highlighted Blue Cross Blue Shield as a deal, and we highlighted Fifth Third Bank as a deal. Those 2 deals brought in 2 million of initial contract value between them. So the underlying figure last year was 36 names and 3.3 million of initial contract value against 39 names and 5.2 million this year. So actually, performance this year on initial contract value signed up per deal, if you can do that and you do those simple averages, is pretty high compared to where we were last year. So allied to that, new deals 30 to 40, it's still good on the high street, people want to buy it, they're still doing those upsells, and they're staying around for a long time. So all of that customer care and lifetime is still being retained. If we've done one thing well, we have brought in 3 companies in a short space of time. Within a 6-month window, we acquired 3 companies and grafted it onto quite a small thing ultimately, and we haven't cocked it up yet. And it's easy to cock it up, obviously. In M&A, there's loads of research on M&A that most of it fails. And we have to be careful and selective about the type of companies that we take on. We took 3 from 5 during that time, so we didn't take 2. We did some great deals on price, and we'll be able to describe that now to you. You know, looking backwards, what's happened. I don't think that sort of pricing is going to be possible going forward as we continue on M&A. We've got a name for being a bit sort of cheap on pricing, aggressive on pricing, whichever way. So we're going to have to accept that that's not a sustainable pricing level that we can achieve going forward. And then we haven't stood still on development. So as well as the normal development of the existing modules to make them still good for the high street for next year, the next year, the next year. Sorry.
No question.
Have you encountered any cultural issues in your M&A?
Yeah, loads of them. And yeah, as you'd expect. There are different ways of doing things. People have different views on HR and training and internal stuff like that.
Any lessons from that? Any things that you perhaps wouldn't have done with hindsight, or you might change?
No, on the 3 we've done, I think pretty content. You wish that you could. I mean, we took a business in Phoenix. It's a great business. It's actually a services business, not a software business, but it's in proper procurement. They do outsourced managed auctions, and I think they're very relaxed, which is another way of saying when I walk in the door, I'm pretty frustrated about the work level. So trying to light a candle underneath them to give them a bit more of an impetus is kind of different, you know. And they say things like, "Oh, we got 25% spare capacity." It's funny that I tend to view spare capacity as excess capacity. So yeah, there's been that sort of thing, and with one of the others, they have a older, scruffier version of the sort of stuff that we do. It is all SaaS, which is quite nice. So it means their clients are fairly long-term and committed. But you really want them to switch over and sell ours because it's better. Well, me telling them it's better is one thing. Them believing it's better is something different. It takes a fair amount of time to win them over, and you have to win them over. You can't go in and smack them. You can't take them out. Well, you can, but you don't have much of a business left at the end of it. And we weren't looking for that sort of M&A. If you flip over a page in a minute, we'll show you.
Describe that, yeah. So back to the operational stuff. So we haven't stood still on product. So we've introduced new material functionality in our spend analytics. So we've developed that and brought it to market for sale this year and subsequent years. So we've not stood still on development. And then finally, and if you've read back on the material, historically you'll have seen us talk about Activate and supplier networking and accelerated payment facilities and Activate Finance. So that's about engaging in an automated way the buyer's relationship with its suppliers and automating how that works, very much like you do as a consumer on the internet and dealing with yourself in those sorts of ways. And so the announcement on Screwfix, which went out on the same day as the prelims, was a real line in the sand there of a commitment that this buyer, fantastic retailers that they are, obviously in order to be a fantastic retailer you have to be an amazing supply chain manager. And they absolutely are, of course, in their goods for resale area. But in their goods not for resale area, where you have all of these non-strategic suppliers of goods not for resale, that's a very, very difficult area to concentrate on and resource properly. There might be high hundreds, certainly, over 1,000 perhaps suppliers that it is not possible to do strategic. So you want to automate that process. And the commitment from Screwfix is to use our software to help them automate truly their relationship with their suppliers in that goods not for resale area. So a real line in the sand, and effectively for us it's a marker that says, right fellas, we've actually got something here. These guys, Screwfix, are telling us that they need help and we can help them in automating their relationship with their goods not for resale non-strategic suppliers. So that's a big thing for us, and it's been 12 to 18 months in the making to get to that point. And now we go down the pathway of implementation and working with them to to roll it out and hopefully bring some, a lot more on afterwards. So we'll describe that in the growth plan. So I think that's all I want to say on the financial section. So we're starting to see after 2 years the benefits of that strategic decision way back in 2010. We're starting to get to scale and profitability and growth and visibility, but we can go a lot quicker. So if we move now on to the growth strategy, the growth story. So here we're saying we've got four pillars of growth. The first one, pillar one, just in summary, is business as usual, 30 to 40 new names, 60 to 80 upsells, doing all of that good stuff that we do on a day-to-day basis, delivering 10 to 15% per annum growth, we think is the sort of logical target. That's what we've been able to achieve in the past.
And this is FinCap's note.
And this is FinCap's note. So this is the only element of growth that is built into the figures in the city. Nothing else is built in there. Growth leg 2 is cross-sell. So after we've done 3 pieces of M&A, each one of those companies has brought something complementary and additive to our portfolio, whether it be a marketplace capability in EGS, or importantly, whether it's a document scanning capability in intelligent capture, or even a capability to deliver reverse e-auctions as a service through Intersource. All of those, to varying degrees, are capable of being sold into other customers within other parts of the group. So intelligent capture brought 40 clients or so with it. It's got a fantastic product. It sold it every day as an independent company. It's now got 460 other clients that are warm bodies, because they're existing clients of the group, to go and sell that service or product into. So we think the cross-sell opportunity is significant, and we're adding in the spend analytics because that's new to market as fresh and additional modularity. Can be sold individually as a module. It's an entry point, if we remember that graph. It's an entry point for somebody to buy spend analytics into their organisation. So we think that can add to that 10 to 15% as additional sales opportunity. And we brought some resource into the group to try and fund that. So there's a sales-based account management team in place, targeted with each one of those different elements of the product to sell that into the customer base. So that's additive in that sense.
And to give you some idea of our development over the last couple of years on this, you may have heard of something called Roslin Analytics. Yeah, a guy called Charlie Clark. Charlie's a reasonably good friend. Our technology is not based on his or anything else. It just abstractly happens to be the same technology deployed in the same way. It's for what laughingly the market calls big data. I mean, I don't really know what big data is. I think it's something that we cooked up from an industry perspective, but it's looking at all of your procurement data from regardless of whatever source it is. So it could be from our systems, it could be from SAP legacy systems, old mainframe systems or whatever, and then scrubbing it, cleaning it and presenting it in a sensible way such that you're working on yesterday's data today. It's a very, very powerful set of tools with a very powerful set of analytics that's going there, including things like predictive analytics, looking at what you've done in the past and how it might affect you on a go-forward basis. So it's a massive development for us. So, I mean, a lot of good value there and not restricted to just our clients.
Next leg of growth leg number 3, is the M&A strategy. So a little bit now about the history of the 3 that we've done, so you can get an idea on the pricing, what they've delivered. So the first one that we did was in February 2014. So 6 months in last financial year, 12 months in the one just gone. 6 months in 14, 12 months in 15. When we bought that company, I mean, Rod described it briefly, it does what we do in a mini-me kind of way, in a cheap and cheerful, less robust, less sophisticated way, generally for smaller clients, but largely public sector through further education, but also housing associations. Good clients, subscription income, really key to that for those 5 measures. It was profitable. It didn't grow, it wasn't growing particularly, but it had high visibility of income. And it brought us some scale within the group. It added 25% of the size of us in one swoop. So it did something for us at the right time. So it was a good acquisition from that point of view. What we wouldn't do, obviously, is then compete with ourselves for the same clients delivering a similar product, one cheap and cheerful, one BMW. So what we wanted to do was, with that deal, was retain the clients. Make sure the renewals happen at the right time, and absolutely keep that revenue solid. Not that bothered about growth in that business, because we don't want to be selling product against ourselves in the high street. But what we do need to do, therefore, is take out the marketing costs, the leadership team costs, we need to take out the finance and admin team costs and centralise finance. So it's a cost reduction exercise. Retain the client, reduce the costs. So when we bought the company, it was doing about 2.2 million of revenue and 200 to 300,000 of operating profit. And we paid 2.2 million pounds net for that. So 1 times revenue, that's not a bad multiple for this kind of area, but it's small, so you get a slight discount for that. But quite high in terms of EBIT multiples. But we knew what we could do with this business. And this last year, the contribution that it's made to our group accounts this year is 2.3 million revenue, so a slight increase, but flat. Let's consider it to be flat. But it delivered 0.7 million of EBIT. So now we look like we've paid 3 times, just because we knew that we could take the cost out. We don't buy companies generally, well, we don't buy companies ever on the basis of a cross-sell strategy. We never say that 2 plus 2 equals 5 on revenue. We buy it for what it is, and we pay a fair price, or what we think is a fair price for what that business is. And if we can see the costs coming out, that's for our benefit. So the second acquisition, which was Intersource, the company in Phoenix, entirely US based. This is a different kind of business. So this is a service company. I thought it was somebody with a straw. This is a service company that is tech backed. So it has a huge piece of software that it uses to run complex auctions, reverse auctions for clients. So think of eBay in reverse. And it does it in the grocery, fast food, restauranting type chain in the States. So this is 2 steps at once here. M&A doesn't come always in the right order. We would have liked that kind of opportunity in the UK to start with, and then perhaps do something in the States. So we had to make 2 steps. So why did we do that one? Well, it had fixed income of nearly 5 million, very small amounts of new business in the year, so long-term contracts. I think we said it was $4.8 million worth of long-term contracts on an annual basis. So something like 95% covered for next year. It was doing 0.6 million of EBIT, or EBITDA, so very little D in these businesses. So fairly profitable against that. And we paid $2.9 million net for it. So it was a cheap deal. It wasn't a distressed seller, but the sellers needed to get out of that business. It was the last investment in a private equity fund. So we took advantage of it. It was 2 steps removed from us from where we would naturally go, or certainly 1 step removed. It was 2 steps from where we are. But in the round, the deal made sense and it was a great price for us.
I think as well, we have our own small organisation in Boston. So if you put the 2 things together, you've got quite a nice critical mass. We've got 50 to 60 clients now in that area. So we're no longer this small little fish in Boston that you can quite ignore as well as you can. So it made a lot of sense to put the 2 things together.
So we've got some scale in the States now, and our revenues are running about $7.5 million of revenue is in the States. So a good chunky piece of a business there now. The third acquisition was necessary. It was a capability acquisition, a tech acquisition. We needed to be able to deliver the thing that it delivers. We business partnered with them for several years before, so we knew them very well. They do document scanning, optical character recognition, using a piece of software that is not ours, but we've now built to replicate and be better than. So actually there's some great marginal benefits going forward. But we needed the capability to manage high volumes of invoices as a bureau, to convert what we think through our Activate program or supplier networking is going to be a requirement for us. So we faced the decision of do it in-house and learn, or go through that pain, or buy. And we bought, because we saw a lot of pain when we tried to do it internally.
It wasn't the technology particularly, it was the fact that they run a bureau that does 50 million documents a year. They know how to do high volume document scanning, and we didn't. We knew how to put the stuff through a scanner, but I mean, it's different when you're putting 40 or 50 million documents through it. So we bought the capability rather than the technology. The technology, it was licensed. We've now replaced that with a more cost-effective version for ourselves, but we wanted it for go forward.
And so in terms of pricing, we paid £1.4 million for that company. When we bought it, it was doing 1.5 million revenue and 0.2, 0.3 of EBIT. So not cheap, not expensive. We knew it was on a growth trajectory, that business. It was got a strategic relationship with Unit 4, which is not one of our significant strategic relationships. So it brought that in as well. And this year it's grown beyond what we thought, if we're honest with ourselves, and it's done 2.1 million of revenue and 0.7 million of EBIT. So it looks like we've paid twice, and we have paid twice current year profit for that business, so with money back in 2 years. It was a cash deal, so absolutely fantastic pricing for us on that deal. But really importantly also, we've got a new commercial director for the group, so the guy that was running the sales side of that business is a fantastic guy, and he's now on top of our UK EMEA sales function. So that deal has worked in every angle so far. But we always put the caveat on that nothing's forever, and we haven't cocked it up yet. It can always happen. So we're ever diligent to make sure that sort of doesn't happen. Where are we now? Well, we are very, very warm on M&A. There is lots of opportunity out there. We are very busy evaluating a number of different opportunities with a view to getting that scale, getting ourselves up and through that 20 to 50 million revenue as a roadmap and as a milestone, so that we can genuinely say that we're at scale. To us, at scale means at least 50 million revenue, 10 to 15 million of EBIT. That's a substantial business that the market should value very, very well. So the next leg then, growth leg number 4. So I mean that's quite exciting. This one is different and presented differently because whilst it uses our software, it's enabling us to meet and to provide services to a new group of customers, and that's the suppliers of our present customers, the buying organisations, without any conflict. So the underlying theme here is automation and efficiency and e-procurement. So you have Cadbury and Tesco very happily trading electronically back and forth every day, been doing it for years and years and years. Fantastic, it works entirely well. That's not us. Likewise, in consumer world, you deal with yourself electronically, you trade electronically every day. And it really works because you look after your record, you look after where the delivery address is, you look after the payment, and it works really, really simply and easily and straightforward, and the goods turn up. Never an issue. In SME world, certainly, that doesn't happen. There is invoices back and forth flying everywhere, whether it's on an email or not, it doesn't really matter, it's still inefficient, it's still a piece of paper on an email. Or it might be embedded in the email, and there's telephone calls back and forth. Have you got my invoice? Have you got my PO? Is it signed off yet? Who's approved it? When am I getting paid? This happens back and forth every single day and is the bedrock of all of the resource requirement that is inside of those organisations, those big buying organisations with non-strategic suppliers who are buying pens or they're buying packaging and stationery, easily substitutable. And our assessment is that, and Screwfix are obviously supporting us with this, our assessment is that that is entirely manageable in today's technology. That's entirely manageable to automate that interaction. Let them self-serve and help themselves to maintaining their own record, to direct entering an invoice onto our system so it flows straight through into the accounting system of the buying organisation and doesn't need to be touched by people undoing envelopes. Or even if they can't do that, send the piece of paper to Telford, to our bureau, Intelligent Capture, and have them process it for you. So huge benefits for the buyer in that efficiency of pushing out and automating the relationship with their suppliers. So they've got something in it that they want to do. And the flip side is the same for the supplier because, as you know, as your consumer, it's easy to maintain your own record rather than wait for a buyer to call you or try and get in touch with the buyer to change your purchase ledger details or your bank account details for payment or your address details. It's easier to log onto a web portal and see where your invoice is and the status, whether it's been receipted, whether it's been opened, whether it's been scanned, whether it's been matched, whether it's been approved, whether it's out for signature. Those processes are all logged within a buyer's accounting system and process, and well known. It's a well-trodden path. You can see that, and you can put a marker on it, and you can show that and demonstrate it on the web portal. Likewise, for later, you can show a due date for when that invoice is going to be paid. And it's much easier for a supplier just to log on their mobile phone, on their iPhone, and find out where their invoice is, what status it's at. They don't need to call Myrtle on accounts payable and play the telephone ping pong until they eventually find out and get irate and snotty phone calls because it's taking ages to get.
It's very interesting that for the last 20 years we've had turf wars going on and fights within a buying organisation as to who owns the supplier record. Purchasing will tell you it's them. Finance will know better. They'll tell you it's them. A bit odd really, isn't it? They're fighting over a supplier record when it's actually the supplier's record. Why doesn't the supplier maintain his own record? Would you let somebody maintain your record when you're buying stuff from Amazon? I don't think so. But that's what commerce has done. All of the records are owned by the buying organisations, including the time taken to keep them up to date badly. And if you ask them how many they've got, how many have they got? 14,000, 12,000, 10,000. They haven't, because a lot of them are duplicates and triplicates and old rubbish that's found its way in that's never been taken out. No one notifies the supplier when somebody leaves and the email address is changed. They might if it was a bank account, but they don't the rest. So you can't communicate between a buyer and a supplier easily. You can't even find out how much money someone spent with one supplier because he's got 15 different addresses. And all of that stuff is sort of in that SME world that Tim was talking about.
One thing, Rod, there's a big thing in the US at the moment with fraud management systems. And procurement is certainly a space where I think, don't quote me on the figure, but it's about $3 trillion a year being fraudulent activity happening. So do you have anti-fraud software or detections which allow individuals, because if you've got 50 million trades or whatever happening within a year, you can have two mates in different companies kind of.
Yeah, let me just describe the sort of volume. Rod's going to describe something that we're doing with Fifth Third Bank, I'm sure. But in terms of the volume of this kind of trade, let's just get an understanding of what that is. On average, 75 to 80% of the goods not for resale suppliers are sending 4 or 5 invoices per year. So this is not a huge, individual trades are not huge like that. There's a small volume, hopefully high across all of the buyers all together, but it's quite a small volume of invoices going. It's consistent, and there's a lot of it if you have a lot of buyers, but individually there are not huge numbers of trade, which is why we will be able to make money at the level that we're describing. But let Rod finish on the Fifth Third.
And we operate things like you would operate on your little, Barclays, where you drop your card in, you get a one-time PIN and all sorts of things like that. But one of the major trends, particularly in the banking sector, is supplier management. And not just supplier, but supplier's supplier. And so, if you like, the risk teams in particular, I think, not Societe Generale, who's the other? BNP Paribas, I think, got about a 7.9 billion fine. Somebody else has got a 6 billion fine, all in the US. They're driving down the level of information and security and certification and warrants and whatever things that you might require for a supplier. And they've made supplier onboarding an actual activity, as opposed to invoice comes in and quite often you can't find the supplier, they type it and set up another one. That's not allowed. You've got to have a formal request for the supplier, the reasons for it. It's got to go through a process. They've got to go through this self-certification and then the approval of the self-certification. And if they're using other tier below suppliers, the same sort of thing, in order to get a really good, high quality supplier. And they're looking, depends what industry you're in. You're looking at things like use of blood diamonds, you're looking at use of children in the clothing manufacturing and rug making and all sorts of things like that. Whatever, you've got to have that level of certification and it's got to be formal. And so we handle all of that. And in fact, we've just done a large project funded in part with the US bank to do something we always wanted to do. So it's a link between the supplier and making sure there is a proper bona fide supplier, not your sister or your brother and all those good things, but also that they are completely cleared from a risk perspective. and they're not in a part of the world that you shouldn't be dealing with. In the case of the Americans, that's half the world. But
and what's Screwfix doing to force their suppliers onto this?
So to come back onto the slides now. So Screwfix are saying, I need help to automate this this area of their supply chain, this goods not for resale, non-strategic area of their supply chain. I don't have the resource to do the 1,000 suppliers that comes toward. I need some help in automating. And that's what they're using. So that's what they're implementing our software into their organisation to enable their suppliers to trade with them truly electronically. Now, Screwfix is an example, going back to the general theme of what was Activate's supplier networking, is you can see at that volume of invoices, which is quite small per supplier, that there's a great opportunity here to provide some great valued services to a new customer group, and we are treating them as a new customer group. It's not a tax on the trade between supplier and buyer. We don't want to do that, because ultimately a tax on the trade gets added back to the buyer's buy price. We don't believe in that. We want to make things more efficient. We're e-procurement people. We're automation people. So we want to make a no hurdle, flat fee, effectively as a software support fee for those individual suppliers to utilise the portal, get value from it, call the help desk if they need to get their user and password names again if they've lost them for whatever reason. So value added services for a minimal fee of £50 per annum. Not Tungsten's 900 plus 3% or Ariba's 10% of trade over 3 million and $3,000 to get on the network. None of that. We want 50 quid to help these SMEs trade electronically every day to help our buyers trade electronically and take efficiencies out of their grit out of their machine. So it's a flat fee, small fee. It works because, as I said, on average, these guys are doing 4 or 5 invoices per year. So if I have to receive that invoice, all 4 or 5 of them, strip it out, unfold it, put it on a scanner myself, type in the details and check the details against what comes through on the scanned image, I can do that for 4 or 5 invoices and make 50 quid. So there is money to be made on £50. I always think £50 is too cheap. We fall out about that sometimes.
We do, because, you know, I've got 200 public sector organisations. Can you imagine the local Beckenham newspaper getting over the fact that Beckenham Council are now monetising their supply chain, wanting fees from their suppliers? I mean, the stuff it hit the fan at 90 mile an hour. You've got to be able to, as a public body, be able to invite people at no cost to participate on the network. Well, we are. But if you want to start to trade electronically and start to see your invoice tray and the movements of the invoice tray, you've got to pay me 50 quid. Now, 50 quid is, in the course of this, shirt buttons. I mean, it's a bar of chocolate in a petrol station is what I'm looking for. No more. I can make my money by actually making the bureau obsolete at some stage. I don't need the bureau as technology starts to advance. But the £50 per annum is a good fee. Now, can we change it later? Yes, of course. Should we? No, I don't think we should.
How much is the, you know, is that supplier going to be supplying lots of different people?
It's a one-time fee to be on the network.
Quite right.
So
they could be.
If he's supplying 3 or 4, it's only 50 quid once.
So if they're getting 3 or 4,
they could be. They could be. Yeah.
Yeah. We only want them to pay once. Yeah.
And that's yearly.
Yearly.
Yeah.
Annual.
Per annum.
Yeah.
Per annum fee. Yeah.
But if you,
software
if you
support,
start
like a
to think
maintenance
about
contract.
it, what we've actually done, now you're on there and you're electronic and you can see your own records and you can actually progress your own money. I mean, we're off to the races here, aren't we?
New customer group, lots and lots of services that we could provide there. As an illustration of what that means to us, 50 buyers, on average they have 4,000 to 5,000 suppliers supplying them. Screwfix is a retailer, therefore it has generally a smaller number of suppliers because their supply chain management skills are much better than your average public sector client at the other end of the extreme. So we're working to 4,000 or 5,000 as an average number of suppliers. That's a £10 million per annum opportunity for 50 buyers. So that's a 10% of our customer base. We're not saying all 500 are going to take it next week. We're saying on a 3-year programme, 50 buyers, 10% take up over 3 years. At the end of that period, that's a 10 million per annum revenue, recurring revenue opportunity. Electronic style margins, so pretty highly profitable.
That's on a PayPal button. There's no invoices going backwards and forwards.
Do you see them also using, is it a way to get them to use your systems to buy from their suppliers?
It may be.
Possible, but unlikely given that our software is for businesses or enterprises or organisations that are spending at least 20 million per annum on that goods not for resale area. So it's probably unlikely that the lead would come in that way. Not impossible, but probably unlikely. Sorry, go on.
You road tested this with Screwfix.
Well, that's what they bought into. That's the commitment that they've made to put that in.
The software's finished.
Software's written and available. In that sense, it's just a question of how they want to implement it. And you can imagine, actually, I mean, what we don't want to do is to start preempting what might happen with putting some city forecasts in, because it's a little bit too early to understand how revenues might flow at the minute. Because if you think about, even if we're thinking about the £50, now how does that £50 come in? Well, we don't just circularise all suppliers and say pay £50. We actually trigger it when there's an order due to it. And if you're receiving 4 or 5 invoices a year, that means 4 or 5 orders a year. Those could be spread out during the course of the year. So we don't know the precise timing of when those £50 are going to come in. And when they do come in, actually they need spreading over 12 months to the next anniversary. So it's a hell of a job to do on the on the bean counting for it.
And it may be that we have to cleanse the supplier files for them beforehand. So that's another opportunity for us to sell anyway.
And they might want to roll it out by doing the first 100 and then the next 100 and then the next 100. Just depends on their project implementation.
Just before we get cut off here, anyone want to guess what the next step is?
Financing.
Correct. So one of the visibilities that they get on the system is the status of their invoice, and when it achieves an approved status, they get to see the visibility and the due date for payment. Now, and we're talking about SMEs here, so I'm sure everybody's heard about tungsten and accelerated payment facilities. We're talking about something very different. It is an accelerated payment facility, but it's very different to tungsten. So you'll describe it's a different population of suppliers, for one. SMEs in the UK on approved invoices, not some global chance of financing businesses that in reality should absolutely be financed themselves anyway, our belief is. You can see how we're onboarding suppliers in an automated way themselves. I think in Tungsten's last RNS, they'd done 32 suppliers in a year, and they'd lent 38 million or advanced 38 million against those 32 suppliers. So really, really big suppliers, really, really contrived process to onboard, really large values of invoices, in our opinion, that should be fundable through
two bank accounts each.
2 bank accounts each, so the processing is intolerable. And they did £100,000 of revenue, and they lost £6 million doing that. Now, that's a strategy to conquer the world, and that's fine, but that's not us. We don't think like that. And so we have no intention of doing that. So we're talking about SME suppliers looking to fund invoices that are somewhere between £5,000 and £10,000 on average, we think, but low denominations in an automated way. And if you think about the differences here, we don't think about it from the supplier side. Traditional invoice discounting is about, I've got a receivable, I can prove to you it's a receivable with a purchase order and a delivery note. I can give you my monthly financial accounts or my monthly management accounts, my annual financial figures. I might have to give you a personal guarantee. I have to pay you a setup fee, Mr. Bank, to get that invoice discounting facility in place. I have to pay an annual monitoring fee. I might get a lend of 70 to 80% of my whole book. And I don't have the time to manage that whole process, thank you very much. So I'm not even going to bother, is generally where people get to on invoice discounting. We think about it completely the opposite way around. If you think about our software is helping people do their purchasing better. And actually, the key point about it is we deal with the automated matching process of a order, a delivery note, and an invoice. When that point happens, what the buyer is actually doing is accepting a legal liability to pay. Now, absent the web portal, The supplier doesn't even know it's a receivable at that stage, but the buyer knows it's a payable. So effectively our software is managing that process electronically, and we get first dibs on the invoice. So what we do is we flag it on the portal to say, this is available. It's free to you now. Do you want your money? And we send an email prompting them to go to the portal, saying, this money is available to you now. Do you want it? And we give them a really, really quick and easy process, the suppliers, a really, really quick and easy process to take their money. And we've coined it as 6 clicks and 3 minutes, and you get your money. No obligation, you don't have to do it, it's not enforced, it's a pure offer of a settlement early if you've got working capital issues, if you've got your VAT bill tomorrow, if you've got payroll coming up next week. So not insignificant businesses, sensible sized businesses, but businesses that have working capital and cash flow issues and have probably not got sophisticated forecasting cash flow patterns, or capability. So it's a straightforward offer at a mid-market range. We're not a Wonga for business. We're suggesting 4%, but it's variable. It's a variable depending on what the buyer wants to do and what might optimise the uptake rather than maximise specific uptake. Of about 4%, we're saying illustratively, and that quick process to settle early and get the money into the supplier's hand in this macroeconomically underfunded SME area. So that's the offer. We think there'll be a high taker. We're partnering with Ultimate Finance to provide the finance, so we don't take the risk on our balance sheet. But the risk is that the buyer goes bust, not that the supplier goes bust. Debt purchase agreement to buy the receivable. So the only thing that the buyer sees is, oh, I don't pay him now, I pay him on the same due date, so he's not any worse off. But then what we really smartly do is then say to our buyers, at any one point in time, I've got a stock of invoices that I've paid 96 pence in the pound for. So I say to the buyer, do you want to settle with me early? Do you want to participate? So we start the ratchet at 98p on the day after. Still a great return for him because he's earning 2% against his margin. And if it's a rolling stock, of course, he's getting high teens, 20% or so return on his cash. So if he's got free cash in his treasury or facilities he's not using that he might be paying 2 or 3 or 4% against the debt, he's got a chance of earning high teens of percent on his cash. So thinking back to the Icelandic banks where you're getting 7 or 8%, this is better than that, and you're investing in your own payables. You know you've got the liability, make it do something for you. Make your cash do something for you. So we have a sliding scale of 98%, 98p in the pound, up to due date of nil, 100% payment on due date. And if we put some illustration around that, same 50 buyers doing their, on average, 200 million per annum of goods not for resale spend. That's the size of the clients. If it's a 10% take-up rate in the supplier, so 10% on buyers, 10% on suppliers, that's 1% take-up rate, effectively, of total spend. That's a 50 million per annum revenue opportunity. So that's why we say, coming back to the story, those 4 growth plans align together with the underpinning of our 12 to 15% organic growth, some add-on through cross-sell because we're sort of product pregnant because of the acquisitions that we've done, all structured with a team to deliver that, as well as a team to deliver that. With M&A, that we've seen deliver us 69% of growth this year, including the 12 of the organic, 46% CAGR on those 2 across the piece over 2 years. With this coming along the side with this new customer group in an automated way, we really do think we've got a huge chance of getting to, that 50 to 100 million in a relatively short space of time. 3 to 5 years is our sort of target.
And relatively risk-free, because the numbers from FinCap are based upon the old conventional business.
Thank you.